Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ATI INC quarterly report. ATI Inc. offers a diverse range of businesses and services across various industries. Some of the key areas include production and sale of specialty materials and complex components, high-performance materials such as titanium, nickel and cobalt-based alloys, and superalloys, metallic powder alloys, and long product forms like ingot, billet, bar, rod, wire, shapes, and seamless tubes, precision forgings, components, and machine parts, zirconium and related alloys, including hafnium and niobium hot rolling conversion services for carbon steel products. The company serves multiple markets, including medical and specialty energy, aerospace and defense, construction and mining, transportation, oil and gas, automotive, food equipment, and appliances, mining. The surge in ATI Inc.'s stock price by 73.41% in the past year can be attributed to a combination of factors. The resolution of labor uncertainty through a new collective bargaining agreement with employees and robust CONE 2025 earnings, which included a 10% increase in sales and 47% rise in net income, significantly boosted investor confidence. Additionally, the company's continued strength in the aerospace and defense markets, with a significant backlog of $3.9 billion, has contributed to its growth prospects. The exceptional Q3 2025 financial results, which exceeded analyst expectations, further fueled the stock price increase. Key highlights included adjusted earnings of $0.85 per share, revenue of $1.13 billion, and record aerospace and defense sales of $793 million. The company's raised guidance for full year 2025 also indicates continued optimism for future performance. The positive market sentiment, driven by analyst ratings and share buybacks, has further contributed to the stock price surge. Overall, ATI Inc.'s strong financial performance, particularly in its core aerospace and defense segments, has propelled its stock price to skyrocket over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the aerospace and defense market, which has seen increased demand for commercial, jet engines and defense products. Additionally, the high-performance segment has experienced year-over-year revenue growth of plus 9.4%, while the materials and components segment has grown by plus 5.2%. The advanced alloys and solutions segment has also seen a significant increase in revenue, with a year-over-year growth rate of plus 7.1%. On the other hand, revenue decline is primarily attributed to the specialty energy and medical markets, which have experienced declines in sales to core markets. The conventional energy market has also declined by 20%, while the construction/mining market has seen a decline of 15%. Other factors contributing to revenue growth or decline include restructuring charges and fluctuations in energy prices, raw material prices, and foreign currency exchange rates. Net income and profit margins overview. The company's net income experienced a significant increase of 32% year-over-year, from $113.6 million to $86.6 million, and 31% quarter-over-quarter, from $110 million to $82.7 million. However, the gross profit margin decreased by 4.5% year-over-year and 3.6% quarter-over-quarter due to energy price volatility and raw material price fluctuations. In contrast, the operating income margin increased by 14.2% year-over-year and 13.5% quarter-over-quarter, primarily driven by a decrease in interest expense and an effective tax rate reduction. The profit margins overall decreased in both periods, with basic net income per common share dropping from $1.82 to $0.80, and diluted net income per common share decreasing from $1.61 to $0.78. These changes indicate a mixed performance, with increased net income offset by declining gross profit margins and reduced profit margins overall. The company is indeed generating positive operating cash flow, as evident from the financial summary and supporting data points. The key indicators that confirm this include a cash provided by operating activities of $298.5 million in 2025, a year-to-date period ended September 28, 2025, with a cash provided by operations of $298.5 million. A clear statement on page 48 confirming positive operating cash flow. These indicators collectively demonstrate that the company is generating sufficient cash from its core business activities to meet its financial obligations and invest in growth initiatives. The company's debt level has undergone some fluctuations over the past year. While total debt decreased by $98.5 million from $3.275 billion to $3.177 billion, long-term debt increased slightly by $0.3 million. However, short-term debt and current portion of long-term debt saw a notable increase of $11.3 million. On the other hand, interest expenses have shown a significant decrease. The company's interest expense dropped from -$83 million to -$74.5 million over the past year, indicating a substantial reduction in its financial burden. This trend is consistent across multiple instances, with decreases ranging from $1 million to $28 million. The financial performance of segments and regions varied significantly in the recent period. The HPMC and AA and S segments stood out as top performers, with revenue growth rates of +9.6% and +5.3%, respectively. Within these segments, the East Hartford, CT Operations and European Business and HPMC segment, excluding Birmingham, UK and Dusseldorf, Germany, performed well. In contrast, the Materials and Components segment struggled, with sales decreasing by 4.9%. The Specialty Energy and Medical segments also underperformed, with revenue declines of 31% and 56%, respectively. Regionally, European Business and HPMC segment, Birmingham, UK and Dusseldorf, Germany, experienced a loss on sale. However, the Aerospace and Defense segment bucked this trend, with revenue increasing by 19%. International sales also represented a significant presence in international markets, accounting for 44% of total segment sales. Management is optimistic about the company's outlook, focusing on core operations and profitable growth in key segments such as HPMC. In the short term, they aim to complete divestitures, manage cash flow, and position the company for long-term success. Long-term, management believes in the growth potential of the aerospace and defense market and plans to drive growth through cost savings, productivity improvements, and strategic investments. They also prioritize risk management by hedging exposure to price fluctuations and implementing measures to mitigate the impact of higher gas prices. The company has made several strategic moves through acquisitions and divestitures to optimize its business portfolio. In terms of acquisitions, the most notable transaction was the purchase of group annuity contracts in October 2023. This move aimed to transfer a portion of the company's U.S. qualified defined benefit pension plan obligations to Athene Annuity and Life Company and Athene Annuity and Life Assurance of New York. On the other hand, the company has also engaged in divestitures to streamline its operations. Two notable sales include the non-core operation from the Forged Products business unit, which resulted in a $1.1 million gain in the third quarter 2025, and certain non-core European operations from the HPMC segment, which incurred a $3.7 million loss year-to-date period, ended September 28, 2025. The company's financial summary reveals a significant investment in its own stock. Specifically, it has engaged in share buybacks, purchasing a substantial number of shares worth approximately $364 million. This move indicates that the company is confident in its future prospects and is choosing to allocate funds towards reducing its outstanding share count rather than distributing dividends to shareholders. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights concerns regarding inventory buildup and potential supply chain disruption. Notable indicators include $5.1 million in inventory write-downs on pages 23 and 38, which suggest that the company is struggling to manage its inventory levels. Additionally, seasonal inventory builds and worsening gross inventory turns and days sales outstanding on page 45 further emphasize these concerns. The explicit statement, inventory buildup, yes, on page 46 confirms these worries. While there is no direct mention of supply chain disruption, indirect indicators such as restructuring charges, page 22, and volatility in energy and raw material prices, page 51, may suggest underlying inefficiencies or vulnerabilities that could impact the company's operations and financial condition. That concludes the financial summary for ATI INC. Feel free to comment below, and I will be happy to answer them when possible.